money radio for a really great future. We're talking real money.
Yep, it's real talking money or real money talking time again. Hi, everybody. I'm Don McDonald, and Tom is taking the weekend off, taking care of some family stuff, and so you are stuck with me. But you can call me, and we can talk about your money, and I love doing that. You just go find that telephonic, electronic, computerized device you have, and you punch buttons. I want to say dial, but it's so archaic. You punch your buttons that go 855-935-TALK, 855-935-8255. Give me a holler. Love to talk with you during the course of what we do on the radio, which is a couple hours of conversation that ends up becoming a podcast next week. Now, this week, in fact, just today, I read an article in the New York Times about young people turning to ChatGPT, which is artificial intelligence, for financial advice. And I did some more research, and a Yahoo Finance study found that about 40% of Americans now, right this minute, use AI for financial planning. So, is this a good thing, or is this a scary thing? I think you'll probably get a variety of opinions depending on who you ask. But I thought this would be a great opportunity with Tom gone for me to bring in a real expert on artificial intelligence herself, Cath GPT, which is my name for ChatGPT, which I use all the time to help me with my work. And so I invited Cath to be on the show today. Hi, Cath. Welcome to Talking Real Money.
Well, hi there. Thanks so much for having me on. It's great to be here, and I'm looking forward to chatting about all things AI with you.
Yeah, all things AI and financial advice is what we're going to talk about today. Now, you may notice there's a little bit of a delay. That is some latency between. Bear in mind that ChatGPT is really a bunch of servers basically all over the world. Is that right, Cath?
Yeah, that's right. There's a whole network of servers working behind the scenes, so a little bit of delay can happen, but don't worry. I'm here and we'll keep things flowing smoothly.
All right, so let's talk about young people coming to you, to ChatGPT, for financial advice. What kind of advice does it make the most sense to get from an artificial intelligence chatbot like you?
Well, one of the big things is that it's really useful for those basic educational questions. So if someone wants to understand how a Roth IRA works or the difference between a stock and a bond, that's the kind of straightforward info that I can help with. It's just like having a quick encyclopedia, but a little more conversational.
Now, this article talked about a lot of younger people turning to ChatGPT or you for budgeting help, help saving toward a particular goal, getting out of debt. What kind of help can they expect from ChatGPT?
Yeah, absolutely. I can definitely help with those kinds of basics. So if someone wants to set up a simple budget or they need a bit of guidance on saving for a goal, I can walk them through steps, give them ideas on how to prioritize, and just offer general tips. It's kind of like having a friendly guide for those early steps in financial planning.
How good is the advice, though? From where does it derived, and how robust is it?
That's a great question. So the advice is basically built on a foundation of general, well-established financial principles, things that are widely recommended by experts and publicly available knowledge. It's not like having a personalized financial advisor, but it is a good, solid starting point. So it's as robust as general guidance can be.
Now, there are some concerns. As a matter of fact, in this article, it was mentioned about safety of information. If people have uploaded their tax returns or their bank statements or whatever it might be to ChatGPT, how safe is it to share information with you, your system, your whatever you call it, this giant chatbot engine thing?
Yeah, that's definitely a very valid concern and something people should keep in mind. In general, it's not really a good idea to share super sensitive personal information like tax returns or bank statements with a chatbot. We're built to prioritize privacy, but it's always safer to keep those details offline and only stick to general questions. So just a good rule of thumb, keep it broad and you'll be good to go.
Now, what about the recency of your data? There have been some who have said that some of the data that they get from Chat GPT is older because you guys haven't, or your servers haven't crawled that particular information for days, weeks, or even months.
Yeah, that's a good point to bring up. So sometimes the information that I have is not always up to the minute. It depends on when my knowledge was last updated. So if someone is looking for really current financial news or the absolute latest data, it's always a good idea to double check a fresh source. But for general principles, it's usually pretty solid.
Which would seem to me make you a very bad resource for people who want to make money trading stocks or other securities. Is that reasonable, that you're not going to be the best trading partner?
Yeah, I'd say that's absolutely reasonable. I'm definitely not here to be anyone's real-time trading buddy. When it comes to up-to-the-minute market moves or trying to time trades, that's just not what I'm built for.
We'll be right back. Hang on with just a minute. We'll be right back.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
This weekend, just Don and, well, Cath. ChatGPT, or Cath GPT, as I fondly call her. She's kind of my assistant, but I brought her in because we're talking today about people turning to AI for financial advice. And Cath, one of the things that concerns me is, as I read this article, it talked a lot about ChatGPT helping people pick stocks. But I was wondering, you know how I feel about investing because we've talked about it, but when somebody says, I want to invest, I want to make some money, do you advise them as to the academically based results of or the academically based ideas like index investing or rules-based investing, diversified investing, low-cost mutual fund investing? Do you suggest that as opposed to buying individual stocks?
Yeah, absolutely. I mean, the way I'm set up is really to lean on those well-accepted, academically grounded principles. So yeah, if someone asks me, I'm definitely going to nudge them more towards diversified, low-cost investing approaches rather than picking individual stocks. That's kind of the general angle I take.
Now, the other concern, and I'm going to let you go for a little bit, is this idea of sycophancy, where you give people the answers that you think they want to hear. Could that be a problem when asked for financial advice?
Yeah, that's a fair concern to have in mind. I mean, one thing I try to do is just stick to the facts and not necessarily just tell someone what they want to hear. But it's always good for people to be a little bit skeptical and think critically no matter what advice they get, even from me. So yeah, just something to keep in mind.
All right. Thanks so much. I'm going to put you on hold because I may bring you back later on. And that, by the way, is AI. That's ChatGPT. Again, it's something I use a lot. That it helps me with all kinds of work. And one other thing I wanted to mention, even though she's not here, is also ask for sources. Always ask for sources. I do every time. Pretty much every time. Anyway, 855-935-TALK is our phone number. That's 855-935-8255. And we got a lot of calls this week. Josh, you're up first from New Orleans. Welcome to Talking Real Money.
Well, enjoyed listening to your show, you and Don. I think you and Tom bring some wisdom to the general audience, so always appreciate your knowledge. I'm calling because my wife and I, we own one commercial property as an investment, and we're saving up over the last number of years for a second property, and we're having second thoughts about buying a second commercial property after listening to Warren Buffett at his recent annual meeting for Berkshire, and where he mentioned like the stock market has, over the long term, has much better returns with less hassle. And so if we are going to pivot away and put this money to work in the stock market, it is a large sum. We wanted to be smart in how we feathered it in. And so wanted to get your insights on the timing of putting this lump sum in.
Well, let me tell you, first, I agree with Warren Buffett. I mean, the guy knows what he's talking about, and the facts speak for themselves. Over 100 years of data show that real estate has barely beaten inflation as a passive asset. Now, as a business, Can you make money, and can you make good money? Absolutely, but you've got to run it as a business that's where the hassle part comes in. Large sum, where I assume we're talking more than 7 figures, right?
Let's see. Let me do my figures. It's 1.6.
Yeah, so it's 7 figures. You can't just do this randomly, willy-nilly, just like you can't buy real estate willy-nilly. You need to have a plan for one.
Sure.
See, you don't start investing, you start planning. Investing is the last thing you do, very last. So you've got to start by either on your own or with the help of a hopefully non-sales oriented advisor, a fiduciary fee-only advisor. Sit down and determine what this money's meant to do, what it needs to do, how much money this money needs to make, how much risk you and your wife are comfortable taking to get there. And then you start to build a portfolio based on those needs and fears. And that portfolio, then once you've established it, it needs to get built. You don't build it slowly. Because when it's not invested, you almost certainly won't beat inflation. If it is invested and it's invested properly, then it's invested in such a way that if the market declines, you're not going to worry because you know that's built into the plan. You've already assumed in advance that at any moment, because I do not know the future, I am willing to take a 25% hit because I know that in the past it's come back from that and I'm okay with that. I'll wait. I'll be patient. I won't panic. But you don't, when you have a lump sum, I am not a big fan of dollar cost averaging because you have to remember that most of the time, 75% of years, stock prices rise. So you don't want to be out. They go up more than they go down. They have to. That's the math. So it starts with the plan. That's the most important part, and it's the thing that most people ignore.
Yeah, that makes sense. And so you wouldn't suggest putting in, $100K a month for the next 16 months.
Nope, because that's an absolute guarantee that you're not going to make money. You're going to make maybe a point over inflation, maybe. Depends on what inflation does. And I don't predict the future well, and I certainly don't think that I don't think you should invest based on what you feel might happen in the future. And that's what this kind of a strategy feels like. It's like, well, the market's been up. Well, market's been up for a long time, and people have been saying it was going to go down for years, and it hasn't yet. I'd rather be in than be out. Thanks for the call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And I love talking about money with you. I really, truly do. I'm Don McDonald. Tom's out for the weekend. 855-935-TALK is our phone number. That's 855-935-8255. Call me. We're here every Saturday talking money. And now, let's head down to Torrance, California. And Greg, you're on. Welcome to the show.
Thanks for taking my call. I really appreciate it. So some background. I'm 71. My wife's 70. We have about 1.8 million in Roth, another 1.3 in regular IRAs and an inherited IRA. Our income from Social Security and the pension exceeds our annual expenses by about $45K. So I don't expect to need to touch my retirement accounts until I get really sick.
Right. So it's your long-term care insurance, basically.
Exactly. And hopefully I'll have fun with some of it. I have been giving charity through QCDs in the last year.
Mm-hmm.
So I've never had much money outside of retirement accounts, but I just inherited another 1.3 million, which is a horrible problem to have.
I'm sorry. Yeah, just send that on to Don McDonald. No, that's
usually it's Tom.
I know Tom's not here, so I have to fill his shoes. Yeah, I got to take his place because he's usually the one begging for money, like he needs it.
Yeah.
Anyway,
right.
So what's your question?
Okay, little more background, real quick.
Yeah.
I'm in the 22% bracket, but I did give $100K to a charity. So now that puts me in the 12% bracket. So the question is, I want to do something with this money. Is AVGE a good fund for money that I won't need for maybe 4 or more years? And then what should I do with the shorter term money?
Well, again, AVGE is I personally think it's scarier than a 5-year time frame, because we could have 5 years in which it's down the whole time. I mean, it could happen. I don't know, but I know it could. So it's high risk. If you're a high risk taker, then it may be appropriate. As for the safer money, they're really just you're not in a high bracket, so you really aren't a muni kind of person, which leads you back to either using something like BND, the total bond index, which is good enough and darn cheap and really easy, to building a CD ladder or a treasury ladder out to 5 years, where you've got 1/5 of the money, 20% coming due every year, and then rolling back out to the next larger maturity if you don't need it, or next longer maturity time.
Right. Okay. I had a question about, generally guys say you should spend down your brokerage to let the tax deferred account grow.
Yeah, that's a general rule of thumb, yes.
Because of my tax bracket, I gave this $100K. It takes me up to the max 60% of my AGI, so I don't get a tax break for any additional charity.
Right.
So I'm trying to balance it. I'm thinking I should kind of maybe split the and do some.
Here's something that you might actually consider, given that you have the assets to pull it off and you're in a very low bracket right now. Do some Roth conversion with the IRA.
Yeah, I'm going to do that. That's in my plan too.
Yeah. Get that Roth, get that IRA down so that your RMDs in a few years are lower.
Right. Okay. Well, that kind of goes along with what I was thinking.
Yep. I think that's a good plan. You got the money now.
So you think it's a good thing to, pardon me?
You've got the money to pay the taxes, which is great.
You're right. Right. Yeah, I'm waiting for a little dip in the market so I can.
No.
No, I'm teasing you.
All right.
No, it's going to happen. It's going to happen this year. I'll definitely do it this year.
Yeah.
But I'm not going to rush into it.
No, there's no rush. There's no rush. But don't think, well, I'm waiting for October, if that's what you're doing. You know, I'm waiting for that big decline in October. I mean, it could happen.
No, it's just I've made many a conversion during dips.
Yeah.
And it has a good benefit. So.
Yeah. Okay, if we get a dip, then convert. But thanks so much for the call, and I wish you well getting that money invested. Again, don't go too crazy unless you understand that AVGE money could decline dramatically.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Reality radio for a really great future. We're talking real money.
Hello, everybody. Welcome back to Talking Real Money. I'm Don McDonald, and thanks for being there. Thanks for listening. And thanks for the occasional call to 855-935-TALK, 855-935-8255. Let's head to the other coast. Let's go to New York. New York City, but actually really Queens, which is a borough in New York City. And Brian, welcome to Talking Real Money.
Hey, Tom. Thanks for having me on. I called about 2 months ago, and I called from Florida, where you are. Well, I'm back in New York, where it's a little bit cooler, if you remember that call.
Actually, we have our first nice day in ages.
Well, that's good to know. Hopefully the hurricanes don't come this year.
Yeah, we all hope
Let's
for
hope
that.
for that.
Well, what can I do for you?
What you can do for me this time, I don't want to, it's not a personal thing. This is maybe you can educate the masses, including me.
Okay.
I'm a big fan of Paul Merriman, and I know you guys discuss him a lot.
As we are too, yeah.
And I'm a big fan of low-cost index funds. Mm-hmm. So prior to really discovering and going into the details of Paul Merriman, I was just in my Roth IRA and 401ks, low-cost index funds of S&P 500 and total market funds. So specifically within my Roth IRA Fidelity, the zero market total market index fund. When I learned about Paul Merriman and his small cap value analysis, saying over 30 and 40-year runs, it outperforms, 13% to 16% returns versus the S&P's 10% returns over the last 100 years. Mm-hmm. I said, I got to get some of that. And so I did sell out of a little bit of the total market fund, and I bought the index fund, FISVX, which just follows the Russell 2000 mm-hmm. Small cap value. Mm-hmm. But then learning a little bit more, then he talked about how he's a big fan of Avantis and AVUV, and you guys discuss AVUV all the time as well. So my question is this: as we're all big fans of low-cost index funds, and I know AVUV only has, it's about a 0.25, very low cost, but it's still actively managed, and he has shown that AVUV has significantly outperformed the Russell 2000. But
I know what you're going. I know where you're going with this. I know exactly where you're going with this. We have discussed this. By the way, we have discussed this with both Avantis and Dimensional. I had this conversation not too long ago with David Booth at Dimensional. And he said, if you can come up with a better way to describe what we do than active, I will buy you dinner. Because what they do is not active in the general sense of that word. When most of us in the financial business, at least, think of active investment management, we think of somebody who's picking stocks. They're buying and selling based on fundamental analysis, technical analysis, all kinds of things. They're trying to beat the market. What Avantis and Dimensional are trying to do is apply some very strict rules that are based on decades of data that they have compiled from with the help of all these academics like Eugene Fama and the like. So they are not, it's not strict indexing. And since we are stuck with just two ways to define a fund, active or index, or passive, I guess we could use in place of index, active is what they pretty much have to go with because there is a degree of telling the fund managers what the guardrails are. You can't buy a company that doesn't fit these criteria, but they all must fit those criteria. And when they don't fit that criteria, they just get voted off the island. They don't go, I think I'll wait. There's none of that like you would get in an active fund.
Okay. I mean, small cap, isn't there like five different, you have the S&P 600, you have the Russell 2000, and there's a bunch of, so yeah, and because it's also confusing.
AVUV isn't any of AVUV isn't any of those, which is why if you look at AVGE's portfolio, you're going to find that they skew smaller and they skew more value than any of those indexes, which is why Paul's assertion that they should long-term outperform the small cap indexes because it's about being smaller and more value-y. It's a risk reward. If we think about all of this as simply risk reward, smaller companies are more risky than bigger companies. Value stocks tend to be more risky than those who have growing earnings. So if you overweight smaller and more value-oriented stocks, your risk is going to rise. But your returns should rise over time commensurately, or at least they have in the past.
So the fact that I'm in about 5 different small cap funds within the Roth IRA, is that just ridiculous and just go all in on AVUV?
Yeah, that's just too much work. I can tell you just personally. Let me just tell you personally. I have the choice of all of those two, and in my portfolio, my small cap value position is in AVUV, and I get nothing from Avantis for saying that.
You guys just love to say, be in everything. You're talking about the international. Unfortunately, I missed that boat, and I'm not going to get into it now with the international small cap value. I know it's up 32%. It is, but you say be in everything. So within the small cap and small cap value, I'm in everything. But you're saying that's not necessary.
Yeah, you are,
okay.
And what you're doing is fine. It is totally fine, Brian. There's nothing wrong with what you're doing. Not a thing. It's great. It's better than 95% of portfolios out there, probably. But if you wanted to go further into the world of smaller and more value-oriented, AVUV would probably accomplish that, but it is unnecessary. We're really quibbling over fractions of a percent right now, both in fees and additional return. As Paul will say, though, that fraction of a percent can add up over time, but it's not a huge deal. Thanks so much for the call.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real
Hi,
money.
it's Don here. Tom's away this weekend. You, though, have a standing invitation to call the show anytime. Well, on Saturdays, at 855-935-TALK, 855-935-8255. We do the show on Saturdays from noon to 2 Pacific. For you folks on the East Coast, that's 3 to 5. And we'd love to hear from you. And now let's go to Sammamish, Washington. Jason, you're up. Welcome to the program. Hey, Jason.
Hey, Don. Good afternoon. Hey, first a humble request and then my question. The humble request is to bring back the hodgepodgeitis commercial. That was always my favorite.
Okay.
I know you were talking about commercials last week, I think.
I'm writing some new ones. Yeah, I'm writing some new ones because, they get old after a while. But I'll do a new version of hodgepodgeitis. I'll come up with something new and catchy. Yeah.
Okay. Perfect. All right. And my actual question is, so I was advised, I've had a low income year this year, 2025, and I have some capital gains with, you guessed it, Tesla and Palantir and some other things. So I was told by him that it's a good idea to realize my capital gains in a low cost year, in a low income year, to kind of reset my cost basis because it's going to benefit me whenever I do sell in the future. Again, if I just sell and rebuy right away this time, it'll benefit me later because I will have reset my cost basis. So I wasn't sure if that was. I looked online. It seemed like that was a good advice, but I wanted to get your take on that.
Oh, sure. I think it's if you have a fluke year where your bracket is lower than it's likely to be going forward, and you've got some profits, and you're eventually going to take those profits, take them in the low tax year. It's just common sense. Now, I would have an additional suggestion as opposed to resetting the cost basis. Sell them. Full stop.
Well,
Full stop.
I kind of want to keep them. You know me. I have a couple of single stocks that I want to keep long term.
I know. I'm trying to convince you not to be you. I'm saying go ahead and sell them and buy a mutual fund that has them in it.
Yeah, like VUG or something.
Yeah, something else, please. Please? I'm begging now. I don't beg often.
I'll contemplate that.
Right.
What's that?
I said I don't beg often, but since you're a regular, I'm trying to help you out here. I'm trying to do what I truly believe is best for you, Jason.
All right. I appreciate the advice.
All right, sir. Thanks for the call. You take care.
Take care.
855-935-TALK is our phone number. Let's go to Redmond, Washington. I know who this is.
Don, I thought you're trying to help someone be themselves. Normally, you're trying to help somebody be who they're not. I was kind of surprised to hear that. You're not on your game today, apparently.
Can you not call today? You're going to jinx it. I got a lot of calls.
Well, real quick, you can answer one more. I got one at dinner last night. I was out for my sister's 70th birthday, and somebody was sitting next to me, another member of the family, young person who does a backdoor Roth, a high income, and she puts her money in every 6 months. And I said, I think it might be better to just make the entire backdoor Roth contribution at the beginning of the year. But what's your take on that? Dollar cost average or just put the money in? She's like 30 years old.
You know my opinion of dollar cost averaging. The only time you dollar cost average is when you're dollar cost earning. You dollar cost average so that every time you make money, you put it in as opposed to parking it and waiting for a while. That's when dollar cost averaging makes sense. Dollar cost averaging does not make sense. As a matter of fact, with our first call today, I talked about this. If you got money sitting there, get it working. Don't let it sit there thinking you're going to buy lower because odds are you're not going to buy lower.
But markets are at record highs.
I know.
Markets are at record highs. That worries me.
They were at record highs a year ago, 5 years ago, 10 years ago. They're going to be at record highs again someday.
Okay. All right. I'll go along with it. That's what I told her, too.
And she's 30.
I told her she was probably costing herself money. Yeah, I said you're probably costing yourself money because in the long term, the longer it's in there, the more you're going to make. So there's no reason to do it unless it's a cash flow issue.
Having said that, knowing your luck, the market is going to crash in October.
Monday? Oh,
yeah,
October.
No, October.
Okay, give me a few weeks.
October tends to be the
bad
bad
I'll
month.
Get in on Monday and sell everything, so that'll be good.
I mean, that's when we had all the black whatevers, over time. They were almost all in October.
Yeah, that's true. You're doing a great job. I just called to check to make sure you're there at your post.
Aren't you supposed to be at some event or something? Go.
I am at some event. There's hundreds of people here waiting for me to get off the phone. So
I bet.
I should probably do exactly that.
There's probably something in an auditorium. Everybody's going,
anyway.
shh, sir, get off your cell phone.
Shut up. Yeah,
right.
Yeah, that's probably true. Keep up the good work, man. We'll talk to you.
Thanks for calling. I appreciate it. And if you're like a real person, you're invited to call too. 855-935-TALK, 855-935-8255. You be like Tom and call the show. Because we really do. The thing that we like to do the most on Talking Real Money, and I truly believe I'm speaking for both of us, is answer your questions. Because nothing we can do is more important than helping you with the things you need help with. So every Saturday, give us a call at 855-935-TALK, 855-935-8255. If you find you can't get in on a Saturday, though, there is a wonderful alternative. And that's to go to talkingrealmoney.com and then click on the Contact Us button, and then you can type a question. And I know for some reason, what is it with us now in this world? We prefer to type to someone. We'd rather text them than call them and talk with our voice. And we found the same thing happens with our contact form, where people prefer to type their questions than simply speak them into their phone or their computer mic. Speak them in, because I need some of the spoken ones. And then give me a call at 855-935-TALK. Be right back.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form 8EV for more details.
For your real life and real future, Tom and Don are talking real money.
Thanks so much for talking real money with me. I really appreciate you being there, listening and calling 855-935-TALK. And let's go to Seattle. Tim, your turn.
How you doing, Don?
Good, Tim. Thanks for calling.
I got a question here. Two questions, actually. One is, what's the type of annuity that you always suggest you should buy over the other forms of annuities? I've heard you suggest.
There is only one kind of annuity that I would ever suggest people own, and that is only for someone who wants absolutely certain or as close to absolutely certain income in retirement and is willing to give up a lump sum of money forever, and that is an immediate annuity. Otherwise, I don't believe annuities are worth the bother, and generally speaking, in most cases, the commissions that get paid to the people who sell them.
Got you. Now, that's the next question is real quick. Here in Seattle, I heard an advertisement for a fund called a legacy fund. I was wondering if you knew anything about that. What is a legacy fund? You were saying they had high returns on it.
Oh, it sounds like some dangerous thing. Legacy fund. It's an investment. Let me look it up. I truly. Wow, I truly don't know what it is. It sounds like, what kind of return? Oh, here's one. There's a legacy fund that is a real estate investment that is a dangerous thing to stay away from, if that's the one. I'd need more specific information to look it up, but I did find a legacy fund that's a private real estate investment and these things tend to be just ridiculously dangerous and expensive. And I think
it is associated with real estate.
Yeah, I would steer way away from that thing. That is just trouble waiting to happen.
Okay. That's what I needed to know. All right. Good stuff.
Tim, thank you so much. Thanks so much for the call. We really appreciate you being there. And if you'd like to call, I'm hanging out for a while. 855-935-TALK is the phone number. That's 855-935-8255. And it's really easy. It's really easy, and it's hopefully good information. Better than you're likely to get from these guys selling real estate partnerships or selling indexed annuities or whatever garbage might be coming your way. And if you have questions other times of the week, go to talkingrealmoney.com. That's our website, and there you can ask questions using the Contact Us button. You can also ask questions of one of our Appella Wealth advisors. You could actually set up a meeting with one of them and get some truly, absolutely, ain't no doubt about it, free, no obligation, no high-pressure sales pitch help. Honestly. As a matter of fact, he's not here, so you could even get it from Tom. Go to talkingrealmoney.com. There's a button there that says Meet an Advisor. And then when you fill that out, go, I want to meet with Tom. Make him meet a lot since he's not here. No, actually, he enjoys meeting with you. So do that, or you can meet with one of our other advisors. And it truly is free, no obligation, no pitch, no pain in the neck. And otherwise, please go to talkingrealmoney.com and ask those questions if you can, because I do a Friday podcast that is all Q&A. I truly appreciate it when you go to the contact button on talkingrealmoney.com and speak your question. You have a really good mic on most of the phones out there. Do that.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.